Okay, what's happening is that now the tax authorities in a lot of countries that tax worldwide income now are literally going after people that have not even exceeded the 183-day period, which is basically what a lot of countries use as their tax period, that if you exceed that period of time, then they tax you in your worldwide income. And a lot of people are doing this in different countries like Mexico, all kinds of countries all over the world, Germany, Australia. And what's happening is they're hearing from the tax authorities on this, and they're literally having to fight things in tax court. A lot of countries change their tax laws, and people don't keep up with them. And what happens is they come in, and maybe they've set up a library card. They might have bought a property. There's so many things that can come into play after you buy a house or you start going to that country. And if you don't, I always tell people, if you've got a lot of assets and you're trying to avoid a lot of taxes worldwide, pick countries that you're going to be moving to, buying houses that have either a pure tax haven status, as a territorial tax system, or has something like a non-dom type system. The reason you want this is technically you will never have a problem in those countries with this, but countries that tax worldwide income, they're very, very careful, and they try to go after every single dime. So you need to be very careful about choosing countries that you're going to be purchasing properties in and going to visit those countries for months at a time. There was a big article in INI talking about this, and it was titled "The Dangerous 183-Day Tax Myth That Could Cost You Everything." And it was talking about here remaining under 183-day mark in any country does not guarantee tax exemption, argues a guy named Marco Messina, as many jurisdictions access broader indications that economic ties, habitual residence, and former registrations. A more effective and compliant approach involves securing legal tax residency in a jurisdiction aligned with goals. In other words, stick with places that have really good tax laws when you're doing this. If you don't, folks, you're going to be running into all kinds of problems. You're going to start hearing from tax authorities, and then you're going to be in tax court, and it's going to be a mess trying to solve the problem. I can't tell you how many people have had this problem in Mexico that I've run across. Mexico's one of the worst that I've run into. And people are they're not taking heed on this. But for decades, nomad blogs and wealth planning circles have cited the so-called 183-day rule as a golden ticket to tax freedom. And basically, they used to come out with this flag theory. You know, it was based on this, bouncing in, bouncing out. But I'm going to tell you something. Now the tax authorities are changing everything, because so many people are getting educated on this and from the internet. And what's happening is they're leaving ties behind to that old country that they thought were okay, and they're not. But the idea is simple. You don't spend more than 183 days in any one country. No country that can tax you as a resident, and therefore you legally escape the global tax net. Now, it's a seductive concept that nomad blogs and wealth planning circles repeat alike. However, as with many things in international tax, the truth is far more complicated. The 183-day rule threshold is only one element in a broader framework that countries use to determine tax residency, focusing exclusively on the number of days spent in the country without considering other critical factors that can lead to unexpected tax liabilities, denied treaty protection, and in some cases even criminal consequences for tax evasion. Now, they were talking about in this article, they said, let's unpack it, why living nowhere for tax purposes may not be the smart or safe option many believe it to be. All right, now the 183-day rule is a simplified shortcut that merely holds up, that rarely holds up. Many countries use 183 days as a formal threshold. If you spend more than that amount of time within their borders, they consider you a tax resident by default under domestic tax provisions. Now, spending less than 183 days, however, does not guarantee that countries will consider you a non-resident. Most modern tax systems consider a broader range of criteria, center of vital interest, where you, the things they look at is center of vital interest, where your economic and personal ties are the strongest, permanent home? Do you own or rent a place suitable or year-round living? And remember, too, this stuff changes. Are you going to be keeping up with these tax laws as they change? Habitual abode. Even if you don't stay more than 183 days in a given year, do you return regularly over multiple years? They also look at formal ties. Do authorities register you? Does the healthcare system cover you? Or do you pay utilities? I mean, there's so many things that can come into play. Presumptions of residence. Some countries assume residency if you fail to prove that you're a tax resident elsewhere. So even if you go under that time period, are you going to be able to prove that you're a tax resident somewhere else? As a result, countries can still consider you a tax resident even if your passport says you only spent 120 days in the country. This is especially true in high tax jurisdictions like Italy, France, Spain, Australia, and Canada, which actively audit and challenge residency-free strategies. Double tax treaties help, but only if you're a resident somewhere. Now, one of the most overlooked facts in the 183-day conversation is the role of double taxation treaties. These international agreements help resolve conflicts when two countries both consider you a tax resident, applying tax breaker rules that focus on permanent home, center of vital interest, habitual abode, and nationality. But is this the key? At least one country must consider you a tax resident for these tax breaker rules to apply. If no country considers you a tax resident, you fall outside the treaty framework entirely. This means that you lose access to reduced tax rates, exemption clauses, and mechanisms to avoid double taxation. You become invisible in the eyes of treaties, and any country that asserts source jurisdiction over your income can tax you unilaterally. Now, source-based taxation, this is the invisible trap for stateless nomads. One of the problems is even if no country considers you a tax resident, you're not untouchable. Most countries impose tax not only on the worldwide income of their residents, but also on income that originates in their territory. We call this source-based taxation, and it affects both individuals and businesses. If you earn income while physically present in a country, even for a short time, you may become liable for local tax on that income. Examples include employment income while working from that country, even remotely, freelance or consulting services you provide in country, business income you connect to a local client or activity, permanent establishment, risk if you operate a foreign company with a repeated presence. For example, if you spend 2 months in Vietnam, earn $30,000 through consulting while living there, and you're not tax resident in any other country and can't show a resident certificate, Vietnam can claim taxing rights over that income. And no tax treaty will protect you because you don't reside anywhere. This situation is not theoretical. Tax authorities now in countries such as Spain, Italy, and Australia have actively pursued cases where people attempted to float above tax systems by constantly moving yet generating local income without declaring it. When modern tax nomadism backfires, and this is what they're going after. This danger applies only to digital nomads, but also not only to digital nomads, but also to high net worth individuals, executives, and entrepreneurs. Tax authorities now may deem that a corporate director or regularly attends meetings in a foreign country has created a permanent establishment for the company in that jurisdiction. Tax authorities could view a crypto investor conducting business development on the ground as conducting taxable activity in a host country. Moreover, under global information exchange systems such as the Common Reporting Standards and FATCA, banks automatically report financial account data to tax authorities. If your bank account country says country A, your SIM card says company B, your company invoices from company C, and your country registers you in a resident as a resident, expect questions. Now, the power of strategic residency, this is another thing. Rather than trying to avoid tax residency altogether, a more sustainable and legally sound strategy is to establish tax residency intentionally in a country that aligns with your goals, lifestyle, and income structure. This approach involves officially cutting ties with your previous home country, including deregistration, and if applicable, paying any exit tax. And exit taxes usually apply to countries that have the tax based on worldwide income if you live there. Establishing clear and documented residency in a new country, obtaining a residency certificate that allows you to access tax treaty benefits, coordinating your physical presence, business activity, and banking to reflect that reality. Several countries offer territorial tax systems or special regimes that create a favorable environment for international individuals. For example, Italy's flat tax regime, I don't like that. The taxes are too high even on that. UAE's zero tax model, but they have a corporate tax, so that's bad unless you retire there. Georgia's small business system and the territorial frameworks of Paraguay and Panama also allow you to become a tax resident without subjecting your foreign income to local taxation. And these are good picks, especially the last two, Panama and Paraguay. The problem with those two is you can't get dual citizenship in those two countries. That's the problem. But the key is clarity. You must claim, prove, and defend tax residency with substance, not just clever travel planning. And having your tax residency is not a burden. It can be a strategic asset, but you must carefully select it based on your lifestyle, where you spend time, the type of work you do, and where your income originates. If you work with international clients, own companies, or have investment income, setting up in a country with a territorial tax system or low tax treaty friendly jurisdiction, you can help yourself your overall burden while keeping your compliance. And like I said, stick with pure tax saving countries and territorial tax systems or non-dom tax systems. The goal is not just to pay less tax, but to avoid chaos from banks blocking your accounts to audits or fines for undeclared income. Equally important is to organize your personal and business life in a consistent and defensible way. This includes aligning your travel habits, professional operations, wealth structures, and legal residence to tell a coherent story. There's no perfect one-size-fits-all, but a well-structured residency plan provides clarity, predictability, and peace of mind, far valuable than chasing loopholes. In other words, don't depend on this 183-day rule. If you do, and you're one of these people that bounce in, bounce out of high-tax countries that tax worldwide income, if you live there, even if it's shorter than 183 days, you better restructure what you're doing. Folks, it can help us out a lot if you give us a thumbs up if you like our videos. And also don't forget to hit the subscribe button right on your screen. You'll get new videos automatically as they come out. This will help us get more videos out to people. And I would like to hear from you. If you got a question or comment, put it below. And if you want to legally get your income taxes to zero, how to get a second passport as quick as 4 months to a year, go to our website, www.citizenshipquickly.com, and just ask for some help. And I look forward to talking to you on the next video. Take care.